My name is Gasia Mikaelian, and I'm at KTVU Fox 2 News in the San Francisco Bay Area. We're talking about the financial ramifications of the COVID-19 pandemic, specifically as we look at housing. I'm happy to welcome to this talk Jeff Ostrowski. You're a Bankrate.com analyst. Thanks for being with me.
Hey, thanks for having me.
Let's talk about how the pandemic is affecting specifically housing and how that's impacting cities. First, let's talk about the impact it's having on housing itself.
Well, the housing market has been an interesting case because back in March and April, we thought maybe this was going to be a repeat of the Great Recession. We were going to have a sharp decline in home prices, and that really hasn't happened. Instead, we've had, in most of the country, home prices staying steady or rising. We've had bidding wars erupting in many parts of the country. 20 and 30 and 40 buyers vying for a house. And the exceptions are a few urban markets. So like Manhattan has been hit hard. Its sales there have fallen just because of that city bore the brunt of the public health crisis. And the city of San Francisco also suffered a bit. But then the suburban areas outside of those cities that were hit hard have done well. And really housing has performed well in most of the country.
Why do you think maybe the suburban areas just outside of major metropolitan cities are doing better than the cities themselves?
Well, the theory, there are a couple of theories about that. One is that people are moving away from dense urban areas. The idea is that it's just kind of scary to get on a bus or a subway or be in a crowded street. And if you're living in a house, you don't have to get on an elevator with your neighbors. You're driving your car into your garage and you're getting out and walking into your house, and you're not interacting with as many people as you are if you live in a downtown area. And then the other thing is that people are cooped up at home, they're working from home, and they just want more space. The kids are taking classes from home, and so it's whereas if you're hardly in your home, it's fine to be in a small apartment in the city, but then if you're crammed into your house all the time, you start to think about the extra space that you need.
Right. We have 1,600 square feet in this little house here. I'm in the San Francisco Bay Area. Pre-pandemic, that felt just about right. Me and my husband, our two little boys. Let me tell you, 1,600 feet feels like a shoebox when you've got two little boys learning at the kitchen table, mom doing her work from dad's office, and dad trying to help it all happen. So can you tell me a little bit about some cities that might be thriving? And maybe that's a strange word to use, but some cities that are actually doing better when it comes to housing, maybe because of the pandemic?
Well, I mean, it's always a double-edged sword. So as you experienced in the Bay Area, the housing market there has been on fire for decades, but the result of that is that you've got just, prohibitively unaffordable home prices. So it's there's always a good and bad when it comes to housing markets, but really most of the country has seen rises in home prices. We've got pretty severe shortages of homes for sale in most of California, and even in places like Rhode Island and Texas, I'm hearing about 40 and 50 offers on a single house. So it's pretty widespread throughout the country that home prices are rising and that there's strong demand for homes. And so part of what's happened is that the supply and demand curve has just shifted. So there are certainly fewer people buying houses now, but there are also many fewer houses on the market. So we've got fewer sales than a year ago, but also way less supply, and so that's causing a lot of these jumps in home values.
So would you agree that, let's say, mom and dad are kicking around the idea of moving next year to find a better school district for the children. All of a sudden the pandemic hits and mom and dad say, you know what, we'll just go ahead and stay here because, look, moving during a pandemic, moving anytime can be difficult. During a pandemic, how's that going to happen? And then many people are wondering here in the Bay Area, look, if I pay 1.2 for a 1,600 square foot house in a great school district, will that value plummet in a couple years?
Right. Well, so I don't think anyone is predicting that values will plummet. Certainly in San Francisco and Silicon Valley, you've seen some softening in appreciation over the past few years, possibly just because home prices rose so quickly and so much that they didn't have much more room to keep rising. There are housing economists who say, yes, we could see some slight declines in home prices next year as the effects from the pandemic roll out. but I don't think anyone is predicting anything close to what we had during the Great Recession, when we had these 40 and 50% drops in home prices. I just don't see that happening this time around.
And a lot of people do compare what's happening now financially to the 2008 recession. I had another expert open my eyes and say, look, the 2008 recession was because of housing. It was
Right.
all about housing. It wasn't, sort of one tentacle of this major worldwide impact. So that's how the COVID-19 pandemic is very different than what we had, 12 years ago.
Right, right. Yeah, and I fell into that same trap when this recession started. I immediately thought back to what we experienced in the Great Recession, which was the home prices plunging by 50%, as I mentioned. But if you go back and look at the history of U.S. recessions and how the housing market has performed, really only two times have we seen nationwide drops in housing prices: the Great Depression and the Great Recession. And so in between, we didn't see these nationwide plunges in home prices. I mean, maybe home prices wouldn't rise as quickly, or they might fall slightly. They would fall in certain markets, but we just didn't see a nationwide crash in home prices. And there are a number of reasons why it's different this time. We had a building frenzy leading up to the Great Recession, so there was an oversupply of homes. We had a lending frenzy, so it was really easy to get a mortgage with all the liar loans and the zero down loans. And that's not the case now. Lenders really didn't loosen up their credit standards to anything like we saw back in 2005 and 2006. So we've got people with a lot of equity in their homes, so they're not going to sell at a fire sale price, and they're not going to go into foreclosure. And we've got a shortage of homes that's helping to prop up prices, and a shortage especially in places like California.
Let's talk a little bit more. You mentioned California, specifically Silicon Valley and San Francisco, both major tech hubs. Look, in San Francisco, last time I checked, maybe 6 months ago, I think the average 1 or 2 bedroom apartment went for like $4,000 to $4,500 a month. Mm-hmm. We've been doing a lot of stories here locally about how many renters are realizing, hey, look, if I can work from home and if I can work from anywhere, why am I paying $4,500 a month for this tiny apartment high in the sky in San Francisco? I'm going to pack up and, move to North Carolina, move back in with mom and dad. Do you expect to see this shift to work from home, largely for tech companies, but also many others, affect how much housing and perhaps rental housing is priced?
Yeah, I mean, that certainly seems to be what's happening now. And so home prices tend to be stickier. That is, they don't go down as quickly as rents. And landlords are more willing to lower rents than homeowners are to lower their asking prices. So certainly we've seen drops in rents in some of the expensive areas because of exactly what you described. People realize they can live for half as much somewhere else, and as long as they've got an internet connection, they can still do their job and still get paid. So there's certainly some of that. I don't know. It's hard to say whether that's going to be a long-term trend or if that's just a short-term reaction to the pandemic. I mean, the labor markets and housing markets build up a lot of momentum over time, and so the Northern California has thrived over a period of decades. So it's because the opportunities have kept building and building in the Bay Area, and you've kind of had this exponential growth of high-paying jobs there. People keep coming. And so I don't know if the pandemic is going to really reverse that, or if it's just going to interrupt it, and then things will return to that pattern we've seen over the past few decades. It's really hard to tell.
Let's talk about homeowners who want to stay. I've heard from, it seems, all my friends who are refinancing. Can you tell us, if you have enough equity in your home and you're in a position to do it, I'm guessing financing right now is a pretty darn good idea.
Yes, it is, with some caveats, but you're right. Mortgage rates are at record lows. They're down in the 3% range. If you can get a rate of less than 2%, once you add in fees and points, it's probably averaging more like a little over 3%. But yes, these are historically low mortgage rates, the lowest we've ever seen. And so it probably makes sense for many people to refinance if they haven't done so recently. But you really want to run the numbers, because refinancing isn't free. You're going to pay thousands, or in Northern California, possibly tens of thousands of dollars in fees to refinance, between appraisals and other closing costs and all the title costs. So you just want to make sure that you're saving enough to offset the amount of costs that you're piling up. And then the other issue is that jumbo loans have become harder to get during this pandemic. And in your market, it's about $750,000 that's cut off for a jumbo loan. So that would be one other caveat, that it's a little bit harder to get financing now than it is in normal times. And if you've been furloughed, or if you've had any kind of interruption in income in the past few months, now is not a good time to apply, because you're going to be rejected. But so long as you've kept your job through the pandemic, and you can save half a point or a point on your mortgage rate, it's definitely worth looking into, and it probably makes sense to refi.
You know, as you're talking, and I'm putting your information in one of two categories. People who are okay could be doing a little bit better, and people who are already hurting are now even in a more difficult position. You know, many people say financially what's happening with the pandemic is just widening that gap between I can make it and I'm just barely hanging on. Do you see that happening?
Oh yeah, that's definitely happening. I mean, we've seen the stock market has soared. So people who own stocks have weathered this storm pretty well, and people who don't own stocks are just finding the wealth gap opening even wider. People who own houses are seeing the value of their homes hold steady or even increase, and if people who don't own homes are falling farther behind, and they're not really getting much help in terms of closing the affordability gap from this recession. So that's another dissimilarity to the Great Recession. And the Great Recession really removed the affordability concerns for a lot of people, but this recession hasn't done anything to reduce home prices. So yes, it's for people who are earning good incomes and have assets, this recession will be kind of a non-issue. And then for people who are on the lower end of the wage scale and the lower end of the asset scale, they're just falling farther behind.
If our viewers are just now learning about Bankrate through our conversation, is there a place you can point them to get more information on what your organization provides?
Yep, our website is bankrate.com, and we've got news and rates, and our focus is on helping consumers manage their money and their lives better and more profitably.
I like it. Make the most of your pennies, as I always say. Well, Jeff Ostrowski,
Yes.
it's been a joy talking with you. Bankrate.com. Thank you so much.
All right, thank you.